I think CSL has obviously been one of the tremendous success stories in corporate Australia. I think over the last 20 years, only 3 companies have grown 10% or more in earnings per annum, and CSL is one of them. The other 2 are Macquarie and Computershare. But one needs to divorce the success of the company from the price that you pay for it. And I think the price you pay for CSL is completely nuts now relative to what you could do elsewhere or pay for something else. Like ANZ and NAB, for example, the combined market cap of those 2 companies is roughly 120 billion, whereas the market cap of CSL is 140 plus billion. So you're paying 20% more for CSL than you are for NAB and ANZ together. And if you look at CSL's earnings 1 or 2 years out and base it on consensus, I think consensus forecasts around $3.6 billion of earnings from CSL, and the combined NAB and ANZ 2 years out is $12.5 billion. So for 20% less money, you're buying something that earns 3.5 times as much. And of course, everyone will say, but the one's growing very well and the other one not so well. But okay, so if CSL was to grow at 10% per annum for the next 20 years, its earnings would more or less equate to the combined earnings of NAB and ANZ were it to grow at 3% per annum for the next 20 years. And so you have 20 years' time and you're buying 2 companies. Well, in fact, CSL, you're paying 20% premium for a company that will in 20 years' time earn the same as NAB and ANZ are likely to earn then. And over the course of that 20 years, you will have probably 100% or perhaps a little bit more of your initial investment in NAB and ANZ repaid via dividends. And with CSL's lower dividend yield, you may only have 30 or 35% of your initial investment repaid. So you get a lot of money back a lot earlier. And, of course, if you look at this over a 50-year time horizon, things start to change if you can sustain a 10% growth rate for 50 years. But with only 3 companies having done 10% per annum for 20 years in Australia, and a very small fraction of companies worldwide having done 10% per annum or greater for 40 years, because of course we've looked at the past 20 and we're now looking at the next 20, I think the amount that you pay for CSL's growth prospects is ludicrous relative to what you could pay elsewhere in the market. And I think that growth premium has never been higher, and CSL has been a strong beneficiary of that from a price perspective. Of course, the execution from a business perspective appears to have been exceptional, but we don't own CSL, as I'm sure you can tell, and we would prefer to invest in companies where they seem attractively priced without the need for heroic growth assumptions. I want to flippantly say $150, which is more or less half the current price. But the thing that would take it to $150 is probably the very thing that would cause you to reassess the thesis in the first instance, but something significantly less than its current share price.